Major funding for these broadcasts is made possible by grants from New York Community Bank, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, M&T Bank, Genova Burns. Additional support is provided by AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Cushman & Wakefield, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, New Banks, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, The Moynihan Group, and These Friends.
Where is the economy? Where do we see the real estate market? Where do we see the commercial market, the regular C&I business in 2016? Unfortunately, I don't have my crystal ball, but I have a lot of little balls over here being in the brand new pavilion in Capital One Commercial Bank at 299 Park Avenue. And I'm lucky to have two dear friends to provide their insight on where they see the market growing in 2016. I have Rick Lyon, who is the Executive Vice President in charge of the entire real estate portfolio for Capital One. And on the other side, battling Mr. Lyon over here, is my good friend Mike Slocum, who is the President of Capital One Commercial Bank. So we were talking a little bit beforehand. Where are the opportunities? What's going on? And you brought up something very interesting with the equity residential sale.
Well, yeah, I mean, I think it's a fascinating deal. I mean, one of the headline was who's right, Sam Zell or Barry Sternlicht. Right?
So for my audience, tell them what happened.
So Equity Residential sells a major portfolio, a piece of their portfolio, for $5.4 billion to Starwood's platform. And what is fascinating is, so who's right? Is it Sam Zell saying I'm, top value and time to get out? Is it Barry saying there's still wind behind that thing? And I think it's actually both are right. And I think the interesting thing is going from an equity player in equity residential, an equity REIT, who looks at really what is the appreciation of the assets and what can I really get from an equity perspective and those returns, versus a Barry Sternlicht who's really managing a fixed income portfolio in his core fund and saying, I can buy at a 4 cap and leverage and finance. He's actually buying at a 5.5, leverage it at 50%, 60%, 70% at a 3% or 3.5% coupon. He can get a reasonable return at the same time.
One time before he was the president of the commercial bank, he was a real estate expertise. So he's still knowledgeable and rather knowledgeable running over the bank and looking over you. How do you look at, do you think Sam Zell is correct, that we've reached a peak?
I think about not just that transaction, but the upcoming Peter Cooper Village Skytown transaction, and that was kind of the peak before at $5.4 billion, and guess what? Back under contract at $5.4 billion.
Right.
So I guess you're back where you were. Can it go any further, or are we at the peak? It seems like it It's about at the top.
You know something? One of the good things about Capital One Bank and Capital One Financial, it's a variety of businesses that you can determine an asset allocation in different areas. So, for example, under Rick's domain, you guys are not into the Uber or condominiums. You're not going after these luxury $6,000, $7,000 things, and you're conservative, and you're basically lending to people who you know. That's the situation, and you can use the asset perhaps to do credit cards or to do consumer financing in other areas. So you're able to do that. But where do you see the opportunities today? One of the big items today over the last 3 years since we're celebrating the third year of Obamacare is health care. And you've made a big decision on that market.
We got into healthcare in a much bigger way about 4 years ago when we hired a team of people down in Bethesda, Maryland, to begin to build a healthcare business, and it's done really well. And then when GE Capital decided to sell off a number of their businesses, one of them was a big healthcare lending platform, and we agreed to buy about $8.5 billion worth of healthcare loans, skilled nursing, medical office buildings, senior housing, as well as sponsor-driven cash flow, more leveraged loans in the healthcare space. And also, we're bringing over all 240 people that worked in that business. It's a great platform for us. Some complicated lending, a lot of regulatory issues relative to healthcare, and so many different segments from pharma to home health care to medical devices, that it's a complicated, complex business to understand, and we actually like that because it limits a lot of the competition in that space. So we're looking forward to it. We think there's a lot more opportunity. 20% of the economy is in healthcare, and the population isn't getting any younger in the United States. So pretty good opportunity long term for us.
And really, when you look at healthcare, it's really not correlated to the economy necessarily, right? So it has a different kind of correlation, whereas real estate is heavily correlated to where the economy is. So it does give us a nice balance in our overall portfolio mix.
But now, is it going to be in Rick's domain, the healthcare lending for office buildings, or is it going to be in the healthcare side?
We keep it in the healthcare side because so much of what drives the cash flow of those is what's going on in reimbursement rates, other issues relative to what's going on with insurance coverage, insurance reimbursements, government reimbursements, Medicare, Medicaid, Obamacare, whatever it is. And Rick is a little bit more of just focused on...
The difference is that it's hard for us to underwrite a office building full of small doctors. Right? And so what the healthcare group is doing is really underwriting the hospital that's there and saying this is an ancillary property to that hospital, and it's really critical whether it's that doctor firm or another doctor firm, or they can actually underwrite the medical firm. So we're more of a generic. Same with senior housing. I do the less care there is in an apartment building is my bailiwick.
But in the same way that Mike brought up before, the subject of the boomers are growing day and night. Mm-hmm. So the boomers growing, one of the segments which was big at a certain time in real estate was, the assisted living. Mm-hmm. And it's coming back over there because there's a need for assisted living. Now, I have a senior care policy, and I just got a 60% increase from Genworth on this situation, because people are going to assisted living mm-hmm. facilities. They're qualifying for a condition that they can get there. What's the bank's thought about lending to the assisted living communities and to also the cared communities?
That really is what falls into our healthcare real estate.
And it's something that GE's done very successfully. We'll continue that. Right. But it's to operators that are operating multiple facilities, maybe in multiple states, and so if things don't lease up as much as they would hope in one spot, we've got it covered with the cash flow across the footprint. We don't do a lot of construction. We don't do a lot of, we do more stabilized properties there, and the challenge with assisted living is really getting it filled up to begin with and then keeping it going after that.
In a way, let's be realistic, and it's an area that the bank has been conservative. and I think very smart, is you've really not done much in the hospitality, in the hotel business, because it's a daily operation. It's like the restaurant business, you know, each and every day you have to have that customer come there, and if they don't, you have a vacant bed.
Right. And it really takes, I mean, you can do good hospitality and hotel lending, but it takes a really particular expertise that we don't happen to have in-house. And we've looked at it, we thought the volatility and also the understanding of an operating business. Is that a real estate business, or is it more of a restaurant and all the other services one provides? So we have a hospitality slice, but it's a very modest one.
Now, with regard to that, one of the areas that you have done is, you know, the organizations who represent the GSEs, okay, the government service enterprises. You've lent to the Arbors and to the other things, and then you've also bought one. Right. How do you look at that market today?
I mean, it continues to be a robust business for us, and again, it's about being a specialty, really understanding it. That may not be a high-risk business, but it's a very technical. How do you have to perform every day exactly? And we build a team that can do that. So it's been a very big business, very successful business for us. And we had to lead like one of the largest transactions that happened when Home Properties bought, or when Home Properties sold to Lone Star. Katie came to us and asked us to help lead that transaction in the warehouse space. So those are the kind of transactions that we are very good at. We really know that business. We keep it very separate from our own agency lending business. Those are two separate Chinese wall between the two.
Speaking of Chinese walls, the earlier show I spoke about the textile and apparel business and the fashion industry continuing to grow. That's one of the areas, you know, I mean, basically, when Capital One went from the financial company to a bank, they had to determine certain markets that they'd go into. How do you make that decision that the fashion and apparel business, which is a good market, is something that you want? Importers, other businesses, and you know, today the biggest title today in New York City rental of offices is TAMI, technology, advertising, media, and internet. How do you look at those areas?
You know, we see technology, media, telecom as an area that we may want to do a lot more of investment in. But to Rick's point earlier, you've got to have the expertise and you've got to be able to acquire the talent that understands that business intimately and then has the contacts with those companies that you want to do business with. And so we look very closely at each one of these. We also look at where we are. So we're here in New York. Our commercial business is headquartered here in New York. And New York is kind of the apparel capital.
You consolidated everything
exactly.
in these facilities.
So getting into apparel here kind of makes sense. Your previous guest, Joe Nostri, who's on our team, very experienced in that space, understands it. So it was a logical extension for us to do it. Not dissimilar to, we're a pretty big energy lender from our heritage down in the South with Hibernia. We have a big presence in Houston. And so we are a pretty big lender in the energy space, which is, you know, a little more challenging these days at $45 a barrel oil, but, you know, but long term a good business for us.
Being the 10th largest financial institution in the country today, how do you get, and this is something I've always said, you know, I said it to Joe, I've said it to other people, how do you get the next generation of good bankers? How do you find that right type of person for the real estate team? You know, they start in Philadelphia or New Jersey. How do you recruit, which is a very difficult thing, to get the best and the brightest?
Well, you've got to have a good value proposition for young people coming out of college. It is really challenging these days because when I was going through school, going to work in a bank was seen as, you know, a really good profession, pretty reputable business. The last 10 years we've been beaten up pretty bad. So I'm guessing most people coming out of college are not raising their hand going, boy, I want to work in a bank. They want to go work in Silicon Valley. They want to work for Google. They want to work in, you know, different technology opportunities. So we've got to go in and talk about the different kinds of things we've got going on in our company. And as we continue to build out our digital capabilities, we just opened a digital business for us, a digital lab down on 16th and 5th Avenue. Which is 2 stories down there that we took, and we've got about 100 people and that's one of 5 different digital labs.
So
that
what do
are
you mean
very
by a digital
technology.
lab?
They're down there trying to develop the next kind of mobile app or the next kind of application to help people manage their personal business. We've got a big project going in Rick's world to help us more effectively underwrite multifamily by utilizing big data and accumulation of information, fast data, so that we can make much better decisions much quicker than we did before. So we think the next frontier is really who can, digitize their business more effectively, make use of all the information that's out there more effectively than the next guy. And so we are investing in that. So when you go out to try to recruit people to come to our company, we don't talk about ourselves being a bank. We talk about us being a technology company. And in many cases, we really are.
Mm-hmm. What about Dodd-Frank having an effect? We were talking about this prior to the show with regard to the non-bank banks today. I'm watching TV the other night. Unfortunately, I didn't see a Capital One commercial for about 3 minutes. And, in between the non-Capital One commercial, I did catch one of these commercials talking about the non-bank banks, and I could get that. How do you look at that in a variety of ways? One is a bank as a place to lend, and also it's very heavy in your world, in the funds who are in that. Rick, how do you look at this?
They're willing to, and their expertise, their cost of capital, and how they work it. They tend to go up the capital stack further than we will. So we have, in selective instances, partnered with them where we'll take a note, they'll do a B note, and so forth. But they tend to look towards those clients that are in my space that are looking to go up the risk curve. Our stable business tend to be clients who avoid over leverage, high leverage. I shouldn't say over leverage, higher leverage, because they really are risk adverse for the long term.
And you, as on the commercial side of the bank, on the non-bank lenders?
Lots of opportunities to actually lend to non-bank lenders and provide some leverage on the loans they're making. By the time we put our leverage on top of theirs, we're at a number we're comfortable with, not dissimilar to sort of an A and B note concept. And so we've got businesses lending to consumer finance companies, commercial specialty finance companies, and the like, as well as some of the digital platform lenders, marketplace lenders, and to some of the investor groups that are buying some of that product. But we keep a very close eye on what's going on there. But we've been pushed into a little bit of a lower leverage box, and there's a big appetite for higher leverage. So there's an opportunity for the non-bank lenders out there, and so there's an opportunity to us to lend to them to help them execute their plan.
You just moved to this building at 299 Park Avenue, and right across the street at 350 Park Avenue is the building which was once called the Colgate Building. It's owned by Tishman Speyer. And the news of the week was that WeWork, the office co-share company, just took 225,000 square feet. How do you, as a bank, look at it in a variety of ways? As a business model, one idea, and as a real estate company, a lender to a owner who's putting this big concentration on in this type of thing?
Well, I'd say as a real estate lender, I mean, this is very new to have that much space done. So, we're still evaluating a lot of that. We don't feel, we look at some of the companies that are doing that, and we underwrite them as a general tenant. And if they don't have the whole building, we would think that would be fine as any number of a multi-tenanted building.
Right, but what I'm saying is, and I've heard this is an entity which is a non-credit company.
And that would probably give us great consternation.
Right.
Or some consternation until we really understand how that works and the percent of the building they have.
You're talking about us looking at them as a tenant?
As a client.
As a client.
As a tenant issue.
It's a combination on the real estate model and also because the other comment that recently came out is that they were looking for a $750 million line, the same way as a REIT would get a line, that they want you to be in this participation, because one of the areas that you are in, you are in participation of syndicated loans.
It is a newer concept, and I think for us, we kind of like to wait to see these concepts really play out before we become a lender into them. So I think we need to kind of see how this plays out over a period of time and see if it's something we're interested in. But there's so many different places for us to go. Sometimes we're not going to go out into the pioneering frontier and let some of the non-banks participate in that. We'll see if it works out. Not dissimilar to our approach with marketplace lenders, which is let's kind of see that play through a cycle. Everything works great when the economy's doing okay. When the economy doesn't, we'll see how some of these things work out.
Recently, there have been a number of acquisitions or mergers of banks. The announced Astoria Federal New York Community Bank, the First Niagara Key Bank. I think the U.S. There have been this. Do you see more bank mergers taking place over the next couple of years?
I mean, I do. It seems to make sense. I think a lot of banks are, in some sense, running out of gas. You know, the low interest rate environment has really challenged banks that can't originate assets effectively because you can't make money just having deposits, not enough to support your infrastructure. So I think banks that have a hard time originating quality assets are going to kind of run into the revenue wall, at which point they're going to have to look for strategic alternatives. So I think we'll see more of these. It'll be interesting to see how the Fed and the OCC let these mergers go through. Obviously, M&T had finally got through that.
Right.
That's a little bit of an omen or a scary thought to have to go through that kind of process. So it'll be interesting to see how these work out.
Yeah, and again, there are the expense plays where if you take two platforms like Astoria and New York Community, which are sort of right on top of each other, can you take enough cost out to justify the price? You know, but that's sort of doubling down too, as opposed to expansion into new areas and new geographies.
Here's an interesting question. A couple of weeks ago, I did a show called "The Effect of E-Commerce on Bricks and Mortar Retail," and this is a twofold question. Okay, one is the effect of e-commerce is definitely having an effect on bricks and mortar retail, but retailers are still surviving. One of the areas that you may be lending to and other banks lend to is people are buying bank branches or the old Chase, the old Chase branches, the Citibank branches, and the people who are buying them specifically have said to me, we haven't bought them because of the credit of the bank. We just want this as a retail location later on. How do you look at that as a real estate lender? And then I have a different question for you.
I mean, as a real estate lender, first, I mean, there's so many questions in there. I mean, one is I thought it was interesting that Amazon, the original e-retailer, just opened its first bricks and mortar store. Right? So that's an interesting going the other way. As far as, that was very popular some years back to buy bank branches, and really as banks were consolidating in the early 2000s, they were doing that. I look at that and say it's a good retail. If it's a good retail location, we don't tend to lend on speculative, like the bank's going out in 2 years and we think we can get a good retail spot on that. That's not our business per se.
So here's the question. Do you see more today, especially with mobile banking and the internet and all this, a reduction in the change of banking for your own branches and operation?
Well, we do. Obviously, you walk by any bank branch today and you look inside and there's not too many people there. So more and more people are doing banking on their mobile device, on their PC, on their iPad. And so we want to try to figure out how to service those clients most effectively. So investing in mobile apps and other kinds of activities to help them bank the way they want to means probably not having as many branches. And then do the branches, are they full service? Are they limited service? There's very complicated, fancy ATMs out there these days that do a lot of things. So I think we're looking at all those possibilities, and then as we look to go into other geographies, we look at what kind of a format might work for us in those geographies. But I think the brick and mortar days are behind us as an industry, and I think what may drive some of these bank acquisitions is the opportunity to overlapping branches and dispose of many of them, and that's where they're going to get their expense saves.
Combine two branches into one and get cost saves out of it. I think you're also finding some of the REITs looking at this and saying, geez, that whole value of the pad in the next shopping center I'm going to do is usually goes to a bank. That might not be as attractive.
And the same question, how do you see, if we have higher interest rates, what effect is it going to have on the real estate market and on the REIT market?
It is obviously a significant impact to the real estate market. Right? I mean, right now you have. I mean, I look at cap rate spread, and so people ask me if we're overvalued. I don't think we're overvalued, but I think we're full value. Right? So you look at cap rate spread; it's roughly 2.5 today in that. But if you have a 2% rise in interest rates, that quickly needs to have either a squeeze on cap rate spreads or a rise of cap rates. So I think it has a huge effect there. That's why a lot of people are absolutely looking at long-term debt and fixing in it.
One question, because it's not New York City to speak of, but it is part of your domain where you are. What's your thoughts about construction financing for single-family homes?
We don't see a big demand for it. Now, if you want to consider condos single-family homes.
No, I'm talking really
about detached single-family homes. It's so difficult to get the zoning and the permits to do that. And you don't see a huge demand for it. When I was out in Long Island earlier this week and met with some multifamily developers out there, and they were talking about how strong the market is in Queens and Manhattan, but they said they're, for themselves living out in Long Island, their home values have not seen much appreciation, still kind of struggle out there. So I don't know that there's a big demand. It seems like people are now moving more towards into the cities, and the suburbs are not as popular as they once were, so I'm not sure there's a need to build a lot more single family, at least in this market, where people are migrating to the south. I think we see more single family construction going on down there, but up here, not much of a demand.
One question, 55 and older housing. We got to the boomers over there.
55 and older housing makes a whole lot of, it clearly makes sense to build, dwellings in urban environments to attract those 55 and 60s who are coming back makes a whole lot of sense. The old way of just getting a 55 and over community was that I couldn't get the zoning to get a regular community,
right.
So I'll get the zoning to do that. And so now I look at that and say, well, you've got a third of the market that you would normally have that can come here. So, I don't think that's an advantage, and we don't target that market at all.
So as I'm sitting here in the pavilion, are the skies aligned for a positive 2016?
For real estate, I think so. We see growth slowing. We see margins compressing some, but we think it's still a reasonable market. But the wind is, at best, not there at all.
And for the commercial
I think
banks?
it's just going to remain a little cloudy. I don't think it's going to storm. I don't think the sun's going to come out. But it's, this energy issue that really drove the economy to a great extent the last few years, hasn't been fully felt yet. And consumers love $2 a gallon gasoline, but I think they like having a job better.
That's right.
And so we'll see what happens.
And they're not spending that too.
So I'd like to thank the two of you specifically and the entire Capital One team for allowing me to come to your new corporate home, the headquarters of the bank, of the commercial bank, and the pavilion. And I'd like to thank Rick, and I'd like to thank Mike, and I'll see you next week.